Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
20,000 and the market reaction. After the Nifty hit 20,000, the markets reacted sharply the very next day. For conservative investors and those who are very valuation driven in their investment decisions, the past few weeks have been quite challenging, especially to deploy fresh money. While we do get a lot of fresh money, we are unable to deploy them in equity in a timely manner. So we would be forced to wait for quite some time. This is not new for an advisor or a portfolio manager, but it's very new for the investor to be told that his money will be deployed only over an extended period of time. The investor immediately starts to think, oh, if my money is idling, then I'm losing out on returns. Such is the anxiety to immediately deploy money. But it makes little sense to deploy money aggressively and mindlessly when valuations are not in our favor. When we don't like valuations, we must learn to wait. There is no alternative but to wait. And the benefits of waiting is something investors almost always ignore. Let's say the valuation is 50% above the range in which I would be comfortable investing into. And I wait. Let's say I wait for 3 months. During this period, I expect valuations to moderate. If valuations moderate to the zone where I am comfortable deploying the money, I can immediately take that money and deploy it into equity. In the interim period, the money can be kept in debt instruments to earn something close to 6.5% per annum. So it's not as if the money is idle. But to an investor, it appears that any money that is not being immediately deployed in equity is idle money. Such is the fear of missing out. With such a strong FOMO factor, investors definitely want money to work for them every single moment. But when valuations are not in favor, idling money could be the most profitable way to invest, because if you wait for a few months and then you get valuations 10% cheaper, then definitely that would help you significantly alter the investment outcome and improve your returns. So investors must learn to wait when valuations are not in favor, and they must accept the views of managers who are erring on the safe side with their money. It's better to err on the safe side than to err by investing in haste. If the investor supports the manager or the advisor, he would be more bold in staying out of a market that could eventually spell loads of trouble to the investor's portfolio. So this is the time to be very, very circumspect and very choosy in your investments and not to rush to deploy capital. Money can wait if the opportunity will only get better over time. What I expect as the benefit from waiting is very simple. Whatever stock an investor wants to buy will be available at least marginally cheaper if the market corrects. And with global news flows also not being very favorable on inflation and macros, the market could see a few days when the fear spikes and valuations suddenly fall or decline very sharply. This window, whenever it presents before an investor, must be used to deploy money which is idling or which is kept ready to be invested on a correction. By investing money during the dip, you would be able to definitely lower the valuation of your portfolio, improve your efficiency in purchase, reduce impact cost, and position your portfolio for a better performance than you would achieve by rushing to deploy the money right now. Thank you for watching this video.